Want to profit from a stock dropping without shorting shares or risking unlimited losses? Let's talk about the bear put spread, a defined risk, high probability strategy for when you're bearish and want to stay capital efficient. Here's how it works. You buy a put at a higher strike and sell a put at a lower strike. Same expiration. You pay a net debit to enter the trade. If the stock drops below the lower strike, the spread hits max value. Example, Google is trading around $180. You buy the $180 put for about $5 and sell the $170 put for around $2. That's a $3 debit or $300 per spread outlay. If Google drops below $170 by expiration, the spread is worth $10. You paid $3, so you profit $7 or $700 per spread. If Google stays above $180, the spread expires worthless and you lose the $300. That's your maximum risk, and it can be mitigated by exiting the position before expiration with a set stop loss based on the spread's value or share price. Now here's the edge. You don't need to short the stock or pay up for a naked long put. A bear put spread is more cost effective and it limits your downside risk. If you bought the $180 put alone, you'd spend $500 and need GOOGL to drop below $175 just to break even. The spread costs just $300, breaks even at $177, and still gives you up to $700 in potential profit with less capital at risk and no margin or maintenance call worries as long as you don't go crazy with position size. It also helps you avoid a margin drain. Shorting 100 shares of GOOGL ties up around $18,000 in margin. This spread puts you in the same bearish direction but only risks $300. And because it's defined risk, you won't get hit with a margin or maintenance call, no matter what the market does. Again, as long as you don't go too crazy with position size. Let's talk Greeks. You're long delta positioned bearishly so you profit as the stock falls. You're also long vega, meaning a rise in implied volatility works in your favor. Theta, time decay, works against you, especially if the stock just chops around. And you're exposed to gamma, which accelerates P and L changes as expiration approaches. That can work for or against you depending on speed. Best time to use it? When you're bearish and expecting a slow or moderate drop, not a full-on collapse. Ideal for fading overbought setups, negative momentum, or playing a controlled earnings miss. Bottom line, the bear put spread lets you bet on the downside with limited risk, less capital, and no margin stress. It's efficient, defined, and tactical. As always, consult with your financial advisor or account to see what's best for you. Be sure to like, follow, and subscribe for more.